Andrew, if you look at euro pound, which I know Tom likes to look at because it's what the pros look at, is it euro driving it or is it pound?
So I think that in our view, I think the euro has been driving it more recently as the euro's weakened on the back of some of these trade concerns, the fact that certainly U.S. growth was much stronger than eurozone growth in the second quarter. But if we think about that going forward, we're pretty constructive long term on the euro, right? It's a region that's running a very large current account surplus, somewhere in the neighborhood of 3 to 4% of GDP. It's a very inexpensive currency. And if we think kind of longer term, we do see the potential for greater fiscal action, given that budgets in a lot of countries are looking somewhat better. So we're pretty positive on the euro longer term.
Andrew, I think this is an incredibly important question that Francine brought up, the partial differentials of any pair against the euro right now. I looked at Germany's surplus today, and it's a remarkable linear function. What level of euro do we need to break the trend of German trade surplus?
Well, that's a hard question, one certainly that is above my ability to model. But, when our FX strategy team looks at it, they think that there are very good, reasonable arguments to say that fair value for the euro is closer to kind of 135 against the dollar. Now, obviously, currencies don't need to trade at fair value in anything close to the near term, but that's where they think would be something that would be a reasonable fair value on both a current account basis and also a purchasing power parity basis.